Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today I'm joined by Matthew Ricciardella. Matthew is the CEO of Crystal View Capital. He's a member of the Fund 2 through 5's Investment Committee and Management Committee. He's got over 20 years of real estate experience. He's personally been a principal in over $1 billion in real estate transactions and currently runs over $600 million in assets under management across various vehicles. So, Matt, thanks so much for joining us today.
Yeah, absolutely. Thanks for having me. I appreciate it.
Absolutely. We're excited to have you on. Maybe let's kick it off. Let's just learn a little bit about your background. Tell us about, kind of how you got started in the real estate business.
Yeah, it's kind of an interesting story. I'll give you an abbreviated version. I grew up in upstate New York in the Catskills and was not a good student. Did maybe 1 year, a year and a half in college, dropped out. And at that time, I really wanted to become wealthy. I had no clue how, and thought to myself, what industry could I go into that's going to allow me to attain wealth without a degree? And there you go, real estate. It was right in front of me. So I moved to Southern California in 2002 and actually started as a residential realtor. And my business model at that time was purely prospecting. So I had no contacts, no capital.
Why'd you choose California?
I don't know, kid growing up in New York, big change. Wanted to see the other coast and what that was like. And that was an amazing experience. And like I was saying, I really built my business up through prospecting. So just face to face, making 100, 200 phone calls a day, on the phone. And that's how I built my business up until one day I contacted somebody in a cold call and they said, well, why don't you buy my duplex, which was in Long Beach, California. And this was the day and age when, basically they were giving out loans to babysitters. I didn't think I could get finance, but I could. And I had no credit, no money, but was able to get financing, bought a duplex for $330,000 and sold it about a year and a half later for $700,000.
Wow.
And that launched my career. I from that point forward said, why would I ever be a realtor? I'm just going to go and invest for my own account, and did that very, very well until I kind of wanted, safe, perpetual revenue streams coming in, which flips wouldn't provide. I wanted cash flow day in and day out, year in and year out. So I got involved in commercial real estate, following the same approach, picking up the phone, building a relationship, finding an asset that's underperforming, buying it right, turning it around, generating more free cash flow, and then holding it or selling it. And I basically scaled it up in a fund model, and that's why we launched Crystal View Capital.
Okay, so you crushed it on that first deal. How did that? What was that? Did you renovate it a lot, or was just kind of just market tides?
The latter, I would say. We did do some renovations. We did rent the units out for a higher rent. But really it was, I bought it right. I bought it well below market. And we had a tailwind at our back, and I did several flips subsequent to that. My strategy worked. It wasn't a scientific one, but it worked. I never had an eye to go into a house and say, oh, this would look wonderful with marble or green shutters here, or that. My strategy was, hey, if the price is X, buy it for X minus 20 or 30 or 40%. The day you close, go stick a for sale sign in the front lawn, and you're going to make a fantastic spread. And don't do anything to it. Let another remodeler or flipper come in and do it. And
did you get that first deal at a steep discount like that?
I did. And the reason why I was able to do it was back to the phone calls. Back to the, it was, think about 2004, 2005, 2006. These are the years I was doing this. You had no Zillow, very inefficient market. what a seller was willing to accept is, what a reasonable buyer was willing to pay. It was open to interpretation. Today it's a very efficient market where somebody could look up what their home or what their property is worth. Back then,
All the data, all the comps. Yeah.
sellers, buyers didn't have access to that, but I had real knowledge of the marketplace and I was able to buy right.
Yeah. That's great. So take us onward. So you close this first deal, you do a really good job with it. What's next for you? And we're also coming in, we're starting to rub against, 2008.
Yeah. So,
Sure you get to that.
Probably did 15, 20 flips in a similar fashion. And again, I would say from 2004 to 2007, around that time, I started getting involved in just buying commercial real estate. So I was buying office, retail, multifamily, industrial, and kind of fell into self-storage and manufactured housing communities because very fragmented market, a lot of mom and pop ownership, very inefficient marketplace. And that served me extremely well. During the downturn, to answer your question, 2008, 9, 10, those assets actually outperformed in those down markets. So people needed more affordable housing, people that were more transient because of the dislocations that occurred during the great financial recession. They went out there and they needed storage units. So our assets actually did better in those down markets. And it's the same today. It's very, very attractive, safe, predictable cash flow. That's why institutional capital loves both of those asset classes. That's where our focus is.
Yeah. And these asset classes now are manufactured housing and storage, correct?
Yes.
Cool. Okay. So when did the fund come into the picture?
Yeah, 2014, Mike. We went ahead. We launched Crystal View Capital Fund One, and it was challenging to raise capital. With no real track record. I had some personal deals that I did very well with, but I had no experience raising outside capital. So you really had to grind and hustle to go out there, get in front of people. Do the dog and pony show. Brought in capital very slowly, but you delivered for people and word would spread and it would spread fast. They'd re-up, they'd write larger checks, they'd tell their friends about you. This is kind of before social media. So I wasn't out there pitching on YouTube or anything. It was just really country club money, relationships. And we raised 10 million in our first fund, went out there, and the strategy was really driven and revolved around self-storage manufactured housing communities. Delivered about a 45% gross level IRR across that fund on a 7.5-year hold. So really exceptional performance. Subsequent to that, launched Fund 2, which was a $60 million raise. And subsequent to that, 3 was a $140 million raise. And now we're actively raising and just about to close out our raise on Fund 4, which is a $200 million equity offering. And the strategy largely, Mike, hasn't changed. It's really a focus and a discipline around these two asset classes, buying them right, and a vertically integrated platform where our team manages the assets from the time we buy them until the time we sell them. And because of that off-market deal flow, we've been able to deliver real alpha and outsized returns to our investors for a decade plus.
Yeah. Okay. This is cool. I definitely want to get into your competitive advantages because I got, a handful of these written down. Let's maybe, take a step back and walk us through your first fund. So you mentioned obviously, raising the first fund, getting the capital, I assume is probably the hardest. How'd you go about that? And tell us about, some of the investments you guys made and kind of how you went into it thinking about it and kind of how you ended up eventually, selling these assets at a nice profit.
Yeah. Well, again, vintage for that first fund was 2014. So great timing. Timing was spot on. Challenging raise, like I said, no track record. I followed the same approach on the acquisition side that I followed personally. So I had a team of 2 or 3 cold callers and myself. We were on the phone all day. We were talking to mom and pop owner operators, bringing in deal flow. And, we didn't have a very scientific kind of underwriting model like we had today. It was really a back of the envelope type of approach. But during that time, it was more like shooting fish in a barrel. I mean, there was 8, 9, 10 caps available kind of all over the place. I kicked myself on most of the deals I passed on. I'd love to buy them today, but the market has shifted tremendously just because of the demand for these assets from institutional capital, which didn't exist back then. Well, we really bought these assets right. We had a team to turn them around, bring rents to a market level, bring in professional marketing, cut costs, drive NOI. And we typically sold them to smaller private equity shops, groups like ourselves that weren't willing to go out there and put in the time and the work to find off-market deals. We'd list this stuff with a broker.
Do you remember some of like the first investments you guys got into? Were they more storage, more manufactured housing?
Yeah, combination. We bought stuff in Michigan. Most of this stuff is Midwestern focused, I would say. We did have some stuff in California and Arizona, but we're really agnostic, Mike, when it comes to geography back then and now. We're in 32 different states. So, it's not as though we're kind of like boxing ourselves into saying, hey, we're going to buy in Las Vegas. We want great value. And if that value exists in New York, Florida, Seattle, it doesn't matter to us. It's all about the story and the path to create value. And that hasn't changed from Fund 1 to Fund 4. And I don't think it will ever change. It's, we're value hunters. And we're the group that's willing to roll up your sleeves and work hard to extract that value.
And then you mentioned the first one ended up selling by 20, or I think you said 7 years, like 2021.
Yeah.
Did you go into that thinking that was going to be a 7-year fund, or kind of how did that play out?
We kind of had it as an open fund is how we created it. So there was no set mandate to wind it down. It was really when optimal market conditions warrant an exit. I will say this, I regret selling anything in it, despite...
That's what I'm thinking too, yeah.
Despite how strong those returns were, we sold most of those assets, let's say from 18 to 20, pre-COVID.
Probably all doubled since then.
Probably, but that's life, right?
Yeah.
If I have one regret in this industry, it's selling assets. But the way these vehicles are structured, people expect an exit. You can't hold them in perpetuity. But if you were willing to hold them in perpetuity, you would do extremely well. It's a different risk profile. It's a different return expectation, a different tax expectation. But we have had a lot of interest from existing investors for us to structure a vehicle exactly in that fashion that's evergreen in nature and perpetual in nature.
That's kind of what I'm thinking about. I mean, how do you guys, as you're going into this fourth fund right now, as you guys are raising for it, are you thinking about this one being kind of more perpetual?
Well, the Fund 4 is a 10-year vehicle. It's got 2 5-year options to extend, so it's could be a 20-year vehicle. But Fund 5 is what we're thinking about creating as an evergreen fund, which is open-ended.
Yeah.
And I'm not going to say it's going to go on forever, but there really would be no set wind down.
Do you think that would be more advantageous in the long run?
Well, it's think about it like a menu. You walk into a restaurant. So it's hard for me to say it's more advantageous because each investor is different, right? If an investor came to me and said, hey, I'm more driven by IRRs, and that's the way I think about investing, then this probably would not be advantageous for them. A vehicle that we have today is probably going to drive higher IRRs. But if somebody says, hey, I'm looking for legacy type wealth with extreme tax advantages that's going to clip a steady coupon for decades, then this vehicle is probably more for them. And I use the restaurant analogy. If somebody walks in and says, hey, I've got an extreme sweet tooth. We can't really give them a steak, right? We're going to have to give them a dessert menu. And
Yeah.
if somebody wants a steak, we're not going to give them the dessert menu. So that's why we want a menu of options for folks based off their risk profile and their return expectations.
Yeah. Let's talk about some of your competitive advantages. So off market deals. Let's talk about that to start. How do you are you guys still doing a lot of like cold calling, or how are you finding these type of off market deals?
Yeah.
And actually, maybe sorry, before you jump into that, maybe just tell us what it for those listening, what is an off market deal?
Yeah. Yeah. So an off market deal, think about it this way. Let's say you wanted to get into this business and you were to go out there and go on LoopNet or CoStar and talk to the brokers that are selling these assets. Those are marketed deals. So what that means is you're going to compete with the rest of the world to buy these. An off-market deal is built off a relationship. And we really pride ourselves in building a win-win with the sellers that we work with, but we go direct to the source. So we would find a legacy manufactured housing owner. We would, meet them face to face. We'd start with a phone call. A lot of these folks, I've been calling and speaking with for a decade plus. One of the advantages of being in this business for 20 years is your data. We've built some proprietary data and software where a lot of these people already know who we are. So we really have an unfair advantage compared to somebody who's just getting in the industry today, because they'd have to build up that data, and it takes years and decades. So we already have it. We use it. We have 8 on our team. They're out in the field constantly. They're networking, taking these owners out to dinner, hearing their story, positioning Crystal View as the ideal suitor. So for a lot of these legacy ownership groups, Mike, it's not always who could strike the highest check. In a lot of cases, it's who are they going to be most proud of? This is an asset their family built over decades and decades with their blood, sweat, and tears. They want somebody who's going to take pride, invest back into the community, take care of the residents, pay them a fair price, structure a win-win deal, whether it's around their tax motivations, or do they want to carry? Do they want to invest back in the fund? Do they want cash? We could do all of that and more. So really, we are one of the rare suitors that could do almost everything that they're asking for. So that's how we go out. That's how we think about off-market deal flow.
Yeah, that makes sense. I guess with off market deals, are these in because a lot of times, like you mentioned, like they built up this community, they have a great kind of they want this community, or this maybe mobile home area to thrive. Uh, with that, are you guys getting like pretty significant discounts still compared to like what they would get in an open market deal?
It just depends. It really depends. Like for really high quality, like let's say an institutional quality community, not really. You're not really going to get a huge discount, but we're going to give them something that they want, which is an ideal suitor. On something smaller that's a heavier lift, we're probably going to get a pretty significant discount to where it would trade in the marketplace. But it comes with a heavy lift. A lot of groups are not vertically integrated. A lot of our peers and competitors, Mike, and this is what I mean by vertical integration. We have an in-house.
Yeah, this is actually my next question for you. So this is
sorry.
you're teeing yourself up. This is perfect. Yeah, let's get into the vertical integration.
Yeah, so we have Osprey Management is our affiliate company, and it manages all of the assets within the Crystal View portfolio. And there's about 150 on that team. And what we do is we're managing the asset, collecting the rents, making sure that residents aren't delinquent, bringing in professional marketing, but more importantly, bringing a vision to the table. How can we really create value here? A property management company doesn't bring a vision. They bring some core competencies around producing books and records, collecting rents, and earning their fee. And that's about it. And our peers and competitors, they outsource the ownership of their assets and their portfolio to a third party that thinks about it like a property manager. The difference here and the power of the vertical integration is the vision that we bring to the table. We have an alignment of interest because we are an owner. I invest a lot of my own capital into the funds that I sponsor. Our team invests a lot of their capital and their net worth as an LP in the funds that we sponsor. So we go about management like an owner. Our mantra here is think like an owner. So bringing in new homes to fill vacant sites within the communities that we own, bringing in professional marketing, professional management, cutting costs, driving NOI, positioning that asset so we could go to a lender or a bank. We could refinance it, pull out maximum loan proceeds, or when we go to sell it 5, 10, 15 years down the line, we've fully maximized its performance and we're selling it really at its peak. So that's the power of vertical integration as compared to just kind of flipping off operations to a third party that doesn't know, doesn't care, that's just interested in generating a fee. So that's delivered a lot of alpha to our investors over the last 10 years plus. That capability, that competency.
Yeah, that makes sense. I'm assuming if you guys have a third party management, I mean that would eat up a lot of the fee, or like I guess like charge a lot of the fees, kind of reduce return. And like you said, like kind of the ownership aspect too sounds really important.
Yeah, well, we do charge a fee. The big difference is that we charge a market fee. I don't think their fee would be any difference. The big difference here is the vision, the ability. A property management company doesn't really have the ability to go out there and buy homes from, let's call it Clayton or a manufacturer, buy used homes, bring those homes in, have a crew to rehab them, set them up, market those homes aggressively in the marketplace, sell them, bring in a professional marketing, inspire their on-site team to bring in referrals, understand how to cut costs. Again, a property management company is kind of just there to collect the rent, produce clean books and records. But really the vision of the asset and the value creation is going to reside in the owner. And, if the owner isn't investing the time and the energy in that, then their properties aren't going to perform to maximum potential. And that's who we like to buy from.
Yeah. Yeah, that makes sense. Yeah. Just even with my, I just have a couple properties in my personal portfolio, but for example, I'm at the lake house right now, which is an Airbnb, and I'm here, fixing it up. Constantly, I'm adding a golf simulator right now.
Okay.
Which is, it's something that I, to your point, a lot of the neighbors that have Airbnbs are not doing that, type of work to add that value. So I like that aspect.
Yeah, you got to go above and beyond and bring something a little extra to the table.
Yeah, for sure. And even when I leave this place for a couple weeks or a couple months, we got the cleaning team here. They're great. But things tend to slip. So it's, I could definitely see being like the owner management versus, outsourcing that aspect.
Yeah,
for sure. They forget to put out the bath mats, or, the salt, the water softener doesn't have any salt in it.
You really care at the end of the day. And and here's what makes the difference between, and I'm not saying they don't care, but when you have your own money on the line, that's what creates an alignment of interest. And that's what I always tell, by the way, our investors who have conversations with me. They always say, hey, what questions aren't I asking you? And inevitably, they fail to ask the most important question of all. And that is, how much of my own money do I have at stake? Because that really separates conviction from conversation at the end of the day. And I tell them, whether you're going to invest in Crystal View and myself or one of my peers or competitors, understand how much money of their own money they have invested in that deal. Otherwise, they're just a sponsor looking to generate a fee at the end of the day. There's no alignment. And for you, you have your golf simulator and you're going above and beyond because you have your own money in it. You're going to think about it differently than a third-party property manager ever would. And that's what's driven a lot of our success is, we put our we put our money where our mouth is. We like to say we eat our own cooking.
I like that. What do you think's the proper amount that somebody like yourself should be investing into this fund? Should it be 10% of the fund, 20% of the fund, or should it be a portion of your assets? That how do you kind of think about that aspect?
Yeah, I think it should be a meaningful portion of that individual's net worth. Depending on the size of the fund, if you're raising a $2 billion fund, it may not be feasible to write a $400 million check as the sponsor.
Right.
You know what I mean? But, when you're writing a check where it's going to hurt if you don't perform, that's the right amount. And that I can't tell you what that is because that's going to be different for every sponsor. I know what it is for me. I invest several million in each fund that I sponsor, and I continue to add to my position over time because I believe in the portfolio. I believe in the assets we own. And I'll tell you, Mike, it's not only for an alignment of interest. I also do it, I got to be honest, for selfish reasons. I don't know where I could get a better risk-adjusted return than being an LP in Crystal View.
It's a great selling point right there. I like that.
Yep.
How do you think about returns? When you guys go to look at a property, how do you think about if you're paying the right price
to when we acquire an asset?
Yeah.
I mentioned to you in the beginning, we kind of ran this back of the envelope type of approach. Today, we have a team of analysts. We have investment committee, which our group comes together. We discuss what's in our pipeline, what we're about to buy. Does it make sense to close on it? So we run a very detailed financial model on all the investments that we acquire. And it needs to make a lot of sense for us. Those return profiles are typically high teens, low 20s with very conservative underwriting. So we'll plug in an acquisitions price, and then we'll plug in some key assumptions around occupancy growth, revenue growth, where expenses are going to be, what's going to be the cap rate at the exit. And that's going to tell us with reasonable certainty and conservatism, where those returns are going to shake out from a cash on cash standpoint, an internal rate of return standpoint, a multiple on invested capital standpoint. And it would need to be accretive for our overall fund to justify writing a check and making that investment. And if it is, and if it passes investment committee, we'll buy it. And if it doesn't, we won't. And that's one of the beauties of really strong deal flow in a pipeline is you could be selective. You're not forced into saying, hey, I don't have many options to choose from. I've got to get my investor capital out the door. I'm just going to buy whatever's in front of me. I mean, that's kind of the antithesis of what we do. And that's why a lot of sponsors fail. They just don't have enough deal flow. They can't be selective, and they're making investments that they probably shouldn't.
It's a really good point. How do you think about deploying capital? So as you started with the first fund, $10 million. Now you're looking at hundreds of $1 million with your newer funds. How do you think about when you have this $200 million? Do you want to deploy this all year one, year two? How do you think about that aspect?
Yeah, I mean, look, I think it comes down to what I just said, just in terms of does it warrant writing a check? We don't really look at investing like, common practice would be, hey, I'm going to put X amount of equity out per year, and after I reach that limit, I'm going to stop. We don't do that. What we do is we say, hey, where is the best value for our investors? If we could put $1 billion out in a year and it's accretive and it makes a lot of sense, I'd love to do it. If it doesn't make sense to put $50 million out a year, I won't do that either. So it's really, what is the market serving up to us rather than, hey, we have a rule to invest this much a year. I mean, it would be a shame to hit that limit and you got a great opportunity and you say, well, I'm going to pass. I'll have to wait till next year because I've hit that limit. Right. You know what I mean? We're very opportunistic. We're very entrepreneurial. So we just won't think in a box like an institution will.
Have there been times you're like, we need to ramp up? Like, the market's kind of prime. These are some really good prices. Has that happened during your career?
100%. It's happened both ways where capital is coming in very strongly, and there's no opportunity out there. And then on the flip side, it's been where we don't have enough capital. Like right now, we've got a pipeline of about 90 million in new opportunities in it. And we don't have enough capital today to take down that pipeline, but we're going to ramp up our raise so that we can. So it's a case in point. We really see good value there. And we're going to work hard to raise the equity so that we could take all these deals down in Fund 4.
Mm-hmm. I have a note here that says, talks about conservative leverage. What does that mean to you?
Yeah, I mean, for us, it means less than 50% typically. Right now we're in Fund 4, we're about 30% levered. We've got a revolving line of credit that we could tap. So when we see real value and opportunity in the marketplace, we could tap into our lines of credit and take those deals down. But, I will say this, if you really push leverage, you're going to juice returns, but you're also kind of flirting with disaster at the same time. So
For
I
sure.
would rather sacrifice a couple percentage points in return in order to sleep well at night, rather than hit the highest overall IRR. And then one minor slip up means that you could potentially lose your asset or your assets. That's just, I'm not judging it. I'm not saying it's wrong. That's just not how I play. So that's what I
Yeah.
mean by conservative leverage.
Yeah. I like that. Do you guys when you guys, make an offer on a property, is it typically, or I guess maybe if I'm wording this right, are you guys typically like paying all cash up front for like buying that property outright?
Typically, yes, because it's not stabilized. And what I mean by that is it's really not at its max NOI, the seller profile that we buy from. So what we do is we'll typically buy it for cash, or we'll use our revolving line of credit. We'll take the asset down, we'll execute the business plan, create value, stabilize it, and then we'll go back to Fannie or Freddie on the manufactured housing side, or the CMBS markets on the storage side, get a new appraisal, lock in that long-term fixed rate debt, typically 10-year IO is what we shoot for, interest only. And if we're successful, we'll pull back out the majority of our initial investment and then rinse and repeat that process again and again.
Yeah.
And that's the approach. And then all the while you're taking advantage of bonus depreciation, all those tax advantages. You're pulling your capital out. You still have great free cash flow, making distributions. It's if it's done right, it's really a wonderful model.
Yeah, it's something I've thought about, as a person with a much smaller portfolio with my properties. If you were like starting out today, like a little bit smaller, you got a property that's got some equity in it. Would you do a move like that? Would you be taking out like HELOCs in these homes to purchase maybe some larger properties?
Well, hard to say. I'd have to understand, what kind of leverage you'd be going up to with a HELOC. I think the better question is, how strong is the opportunity set in front of you? Are you willing to sacrifice for it? Is it something you want to do to prepare for a deal, or do you have a deal in front of you right now? I mean, I think all of those things matter, but I don't think there's anything wrong with putting a HELOC on a rental property. You're not paying anything until you draw upon it, right?
Yeah,
And then
great
and then
point.
you could pay it back down once you have other liquidity events. So you're not really over levering in that instance. It gives you optionality. So I don't think it's a bad idea.
Yeah, I like it. Um, let's talk about your biggest losses. What are some big learning moments for you?
Yeah, it's probably not, I'm going to say something that you're probably not going to expect. You're probably going to expect me to talk about some deal I took a bath on here or there. Now, with that being said, you do a fund, you buy hundreds of investments. They're not all going to turn out exactly the way you planned. But the beauty of the fund model is, and this has kind of been our experience, a lot of investments do way better than you originally planned. Some underperform, but the overall fund, those outperformers are going to more than compensate for the underperformers. So you're kind of back to your projections or hopefully above from a fund kind of aggregate model. We've done some deals that have been break evens or slight losses over the years. It really hasn't impacted returns meaningfully because of the fund setup. But I think that for me, the biggest losses, again, have been selling assets. I think that's just the structure of the vehicle. It's not patient capital. And then probably the bigger one, and this is something I'm looking to change, is not building the right. We've had the right team over the years, but it changes. People's lifestyle changes. People's family situation changes. For me, it's investing more so in the culture of Crystal View. That's probably been one of my biggest losses or misses is my lack of investing more in that culture and preserving it. And because my focus has almost entirely been on the return aspect. Let's go out, let's find great value, let's generate a return to our investors. And that's wonderful. I mean, that's what I've been hired to do by my investors, right? But you got to uphold a certain culture in the process. And for us, it's sacrosanct. And I'm spending more of my time and energy and effort to preserve that culture, to build it, to put the right people in the right seats, and to give them a piece of the pie. In these vehicles that we're going to launch, Fund 5 and beyond, I really want my team to have a vested interest in that GP where they're going to think like an owner. I want them thinking more like an owner. And the only way they're going to get it is when they got a seat at the table and a piece of the pie. Mm-hmm. So that's going to be my focus for the future.
Yeah. And anything else on culture that you think is interesting? Because I think that's an interesting point you brought up.
Yeah. Treat it very seriously. When someone is toxic to your culture, here's been the mistakes I've made too. When you know somebody is toxic and it's not going to work and it's not harmonious to the culture, don't hesitate. Let that person go. It's not serving you. It's not serving them at the end of the day. You're just delaying the inevitable. And you're going to bring down the culture and the rest of the team the longer you keep them when you know it's not a fit. When you know it's not a fit and that individual doesn't fit into the vision and the culture and the dream, cut ties, do it quick. Mm-hmm. Like they say, slow to hire, quick to fire. I've gotten a lot of flack because I let people go. But you know what? I'm here to serve this culture. I'm here to serve my investors. At the end of the day, this isn't a PR thing like, hey, we never let anybody go. The truth is we don't accept mediocrity, Mike. And this isn't for everybody. We're looking for people that are exceptional. We're looking for people that embody excellence. Those people are very, very hard to come by. And you'll bring people in and you'll think they're a fit. And when they're not, it's okay. Let them go, start back over. Eventually, you're going to find somebody that sticks. And it's going to make a world of difference for you, your culture, your firm, and your investors. And that's why I do it the way I do. And it's not for PR. Sometimes even investors don't like when you let people go. But I've been hired to do something and generate an outsized return. And I can't do that by having people that are just mediocre working in our culture. I need exceptional people.
Yeah. Yeah. 100%. What do you see in the market right now? What are some trends you like? Where are you deploying capital right now? Any interesting notes for right now or early to mid 2026?
I know it's boring and this is what you're going to expect to hear, but I don't see a return profile as compelling as what I see in the affordable housing space. Like when you look at a manufactured housing community today, you've got more and more people that demand affordable housing. They're being displaced within the market. They can't afford to buy a stick-built home. Interest rates are high. Rents are extremely high. Where are these people going to live? And we're providing housing and a real service and a product for people that live the American dream. That if we weren't here doing what we're doing on a daily basis, they'd be priced out. And we're very proud of that. And, by live the American dream, we mean we allow them to buy a home within one of our communities. And there's tremendous demand for that. And there's great pride of ownership. And the supply, unlike multifamily, unlike storage, unlike any other asset class, the supply is static or even shrinking on the manufactured housing side. So when you have flat supply or shrinking supply and demand that's growing off the charts, that's just an exceptional asset to be invested in. That's what one of my mentors, Sam Zell, always said, and that's why he was kind of the godfather of this industry. You always look at supply and demand and make your decisions based off of that. It's hard to get hurt. It's also hard when you look at AI and all the displacement that's going on. Here's something that's virtually never going to be displaced. Show me a way, shape, or form that affordable housing is ever going to be displaced by AI. It's just not going to happen.
Right. Very unlikely.
Yeah. In fact, it's going to perpetuate the need and the demand for it even more so.
Yeah, I can see that. What are some of the biggest misconceptions with manufactured housing?
That it's trailer trash. I think it's got a negative stigma from years past. You picture somebody with a ripped T-shirt, a Budweiser, and a hot dog in their hand. Some communities are like that, but the majority aren't. These are beautiful communities: curbs, streets, gutters, health centers, clubhouses. People take great pride of ownership. They're building equity in their homes. They have a piece of the American dream where they wouldn't get it anywhere else. It's their largest asset. They could have a whole yard. They don't have to live in an apartment complex with somebody above them, beneath them, or to each side. So I think it's the negative stigma around trailer trash has dissipated tremendously. And that's why you continue to see, like I said, this demand for the asset class. It's very much in vogue. And I think that tailwind's going to continue in the future.
There any regions you're currently, most excited about or deploying the most capital to?
No, we're pretty agnostic. Really Midwestern focused, I'll say, because that's where we tend to find the best yield. But we own stuff in New York. We owned a large portfolio in Connecticut. We have stuff in Seattle and California and Texas. So really, it's more the story. How do we create value? How do we buy the asset right? How do we create a win-win deal with the owner operator, regardless of where it's located?
Yeah, we talked about in our pre-call conversation where there's been a lot of consolidation within the manufactured housing space. Do you think this trend's going to continue? Like more, I guess, institutional investors coming in, buying out, more of the mom and pop, operators, if you will.
100%. I mean, it's been happening for years. It's going to continue to happen. I see a scenario in 5 or 10 years, like today, as an example, it's more than 50% mom and pop owned and operated. I would anticipate the next 5 to 10 years, it's going to be 20% less concentration. Yeah. So you're seeing massive roll up, massive consolidation. And for us, that's the real opportunity. The real opportunity is to be a part of the game and to buy from the mom and pops over the next 5 or 10 years and become a top 10 operator in the space.
How are you guys using technology and AI on the operation side? Anything interesting or notable there?
Yeah, a lot of different ways. On the acquisition side, we've got proprietary software that basically tracks who we should be talking to, why, when we should get out on the road. On the operation side, collections, a lot of that is done with an AI bot. We have call centers where when leads come in at our storage facilities or our manufactured housing communities, a lot of those incoming calls are taken from an AI bot. They're kind of distilled down in terms of what it is that resident is looking for. A lot of leases are signed remotely through AI. So it's made us tremendously more efficient. It's expanded margins significantly, made us better operators.
Do you guys ever use it for outreach? I've seen some like uh there may be like short clips on maybe like Instagram or something where it's it'll have like a bot reach out, offer every house like a discount like 30% on the market. Like
No,
you guys ever do anything crazy like that?
no, we don't, because I think what that would do is it would detract from the brand. You know what I mean? Like,
Yeah, yeah.
for us, this is a very personal business in terms of dealing with a fellow owner operator. If we were to have a bot call and say, hey, I'll give you 30%, that person phone so quickly, it doesn't even make any sense. This is a relationship business at the end of the day. So there's a time and place for it, no doubt. But you need to know when and how to use it. And that wouldn't be an instance for us anyway to use it.
Yeah, that's a great point. It's especially in this business, like you said, very very relationship driven.
Yeah.
Um, Matt, anything we haven't talked about yet that you want to cover today?
No, Mike, I really appreciate your time. What I would say is, for anybody thinking of getting into this business, whether you want to become an investor, a GP, really make sure you're passionate about it. Make sure you have the drive, surround yourself with the right people, educate yourself, but take action. I see and talk to people all the time that, perhaps were in my position 20 years ago. And it's like analysis paralysis for a lot of people. They're constantly analyzing what could happen right, what could happen wrong, but then the years pass and you've done nothing. I think the reason I've had any sort of success is I've just went out there and took action. And guess what? If things didn't work out the way I thought, I'd adjust and I'd continue to take action. So I think the message and the theme is go out there and take action, make it happen. Don't let anybody tell you you can't do it. Be smart, assess your downside, weigh your risks. But when you're starting with nothing, what do you got to lose?
Great point. Great point.
So I'll leave it with that.
Cool. I love it, Matt. This has been great. This has been a lot of fun. Really appreciate you joining me, sharing your insights here. Where could people go to connect with you and learn more about CrystalView?
Yeah, you can visit our website at www.crystalviewcapital.com. If you're interested in learning more, you could reach out to us at invest@crystalviewcapital.com.
Awesome. We'll make sure to include all that in the show notes. Thanks a lot, Matt.
Thanks, Mike.